Okay, so guys, good afternoon, and we want to look at control accounts because per what we've been learning so far in the financial accounting, what we've been doing is that we've been learning the day books. Okay, so from the day books, you do your ledgers as usual, and from the ledgers, we will try to prepare a trial balance. Then from the trial balance, we will do the preparation of a final account. So basically, the whole concept was like, let's do day books. All right. And you remember the other names for day books, books of prime entry, books of original entry, or journals. All right. It's the same thing. All right. Then we said that from the day books, we need to transfer into the ledgers. The ledgers. Now, when we say a ledger isn't that a big deal. A ledger is like an exercise book. All right. So let me see if I have okay, let me use this book. All right. So let's say you see this book that I've written. It's called Financial Reporting. Financial Reporting. Now, this book is financial reporting. So I can as well say call this one kind of a ledger. All right. But when I open this book, you see some topics being treated. I think the topic, this one, for example, is IFRS 15. All right. But what you see in there is that the book is this, but inside the book is topics that has been treated. All right. So the same thing. Now, when you take a journal, the journal is the book. All right. Is actually a big book. But inside the journal is accounts. All right. So that is that. Inside the journal is account. So inside every journal, what you see is accounts. All right. Is accounts. So let's take like your register. Inside a register, when you open the register, what do you see? The names of the students. Is that okay? So that is that. So the ledger is the book, but inside the ledger is the account. So in every ledger, there is an account. All right. So that is that. So what do you see in the ledgers? So you will see that in the ledger, we have two main types of ledgers. We have the general ledger, the two main classification. You have the general ledger, and we have the subordinating ledger, all right, or the subsidiary ledgers, whichever way you want to call it. Okay, so that is that. Now, in the subsidiary ledger, we can have what we call um the the sales ledger, all right. So, and we can have the purchases ledger. So we have sales ledger and the purchases ledger. All right, now watch this. Do you remember what we used to do in the day books, some of the day books, particularly the ones, the sales day book and the purchases day book? Do you remember? We used to record credit things, okay? So you see, when you prepare your sales day book, you will transfer the the individual, the individual account or the individual people that you sold to on credit. You transfer them into the ledger. Inside the ledger will contain like this one, the sales ledger. It contains the individual receivable account, or let's say the individual debtors account. Don't forget, another name for debtors is what? Receivable. So the individual receivable accounts or the individual debtors account. So you saw the question that we did where we had Quincy, Oliver Twist, we have Paint Products, Second Force, Franklin and Sons. So those Franklin and Sons, Quincy, Oliver Twist, they were the people in the sales day book. So we will open their accounts in the sales ledger. All right, so that is that. So go and watch the part 3 of the accounting process that we did, the day books. All right, so go and watch that video. You understand the names that I've mentioned. So those are the things. So the same thing, this one too contains the individual payable account. So the individual, let's say, creditors account. And here we are looking at the trade debtors. Don't forget. the keyword trade is important because there are other forms of debtors, there are other forms of creditors. But here we are looking at the trade, those that happen through merchandise, all right? So creditors account. So that is what is inside the sales ledger, all right? Now you see that I've said this one contains individual debtors, individual trade creditors, individual trade debtors. So there can be many of them. There can be so much of them. So therefore, we would want to summarize it into one account. Now, if we now summarize, we can summarize all those ones in here into what we call a receivable control account. Receivable control account or sales ledger control account. So receivable ledger control account or sales ledger control account. I prefer using the word receivables because you will know that it is about your debtors only. All right, about your debtors only. So receivable ledger control account. Then this one too, you will summarize all of them into what we call a payable ledger control account. Another name is the purchases ledger control account. But the reason why I don't want to really use those words purchases, because when you say purchases, purchases can be cash purchases or credit purchases. But the word ledger, when the ledger comes in, then you are kind of looking at the credit. So, but I still prefer to call the payable ledger control account so that you know that it is about your trade payables. So you can say trade receivables control ledger control account, or trade payable ledger control account, or you can also call it what? Sales ledger control account, and what? Purchases ledger control account. All right, so take note of that. Any of the names can go. Now, so therefore, what we want to learn today, so once we've summarized this thing, we know that we will now be able to prepare our trial balance, and from the trial balance, what will we do? We will prepare our financial statement. So right now, in this lecture, we are going to now look at how to do a control account. Control account. Control account. That is that. Now, what is a control account? A control account is simply just a ledger account that summarizes all the transactions in the ledgers. So basically, that's all. All right, it's just a ledger account. So first of all, you must understand that the control account is a ledger account. It's a ledger account. All right, but the purpose is to summarize the transactions. So it will be used to summarize all the ledger transactions. So that is what we are going to use it for. So we are going to summarize. So if you take the receivables, we will summarize them. If you take the payables, we will summarize them. Basically, that is what we are going to do. But not only that, the fact that we are summarizing, the reason is this. For example, if I ask you, what is the total of your receivables? What are you going to do? What is the total balance of your receivables? What is the receivable amount you are supposed to collect, let's say at the end of December or at the end of November? What are you going to say? Are you now going to pick calculator? Then let's say you pick your calculator, then you are adding all of them. No, because it would waste time. So if you have done the control account and it is there, you can now just see the figure one time. So that is the purpose of the summary. So it summarizes. And when you are doing that, it will give you some form of accuracy. All right. So it will give you some accuracy. All right. Because it will help you to check. When you sum up all the debtors amount and you compare it to what is in the control account, if it is not the same, then it means that there are errors. So sum up all the individual accounts, compare it to what you have in the ledger account, the control account, and you will see that if it is the same, hallelujah. If it is not the same, then it means something is missing somewhere. So basically, the control account helps you to check the accuracy. And because it is summarizing the things and it helps you to check accuracy, it makes decision making very faster. decision making faster. So it speeds up your decision making. And lastly, it helps you to prepare your trial balance. So it aids the trial balance, aids the preparation of a trial balance. So these are the four major purposes and importance of control account. So this is what we are going to look at. All right. So that is basically that. So now we're going to pick them one by one, and we want to open the ledger account. Now, the control ledger accounts are basically two. We are going to look at purchases ledger control account and sales ledger control account. Now, what I'm going to do is so you first write in the books of the person you are preparing the account. So if it is in the books of, so let's say in the books of City Campus group, which group should I use? So let me use group, let's use H. All right. So this is the person's books, the company we are preparing the control accounting. Now, like we don't prepare control accounts one by one. You have to open it concurrently. So if you have a question on control accounts, you just have to open the two together. So let's say I open my sales ledger. What is the other name for the sales ledger control account? You remember? Trade receivable. All right, ledger control account. So sales ledger control account. So you open it down. Then let's open the second one, purchases ledger. What is the other name? Trade payables, right? Ledger control account. All right. So you have these two accounts. And don't forget, this is accounting. If you need to put the CD sign there, put the CD sign. If you have to put 00s at the top too, just do that. All right. So that's that. Okay. So this is what you have. All right. So basically, that is that. Now, don't forget, this is the ledger account, just as you did for the debtors, individual debtors. So we're going to look at the format and some of the things that should go inside these ledgers so that and I'll explain each and every individual item so that you take it and know how to work the examples. Okay. So first of all, because this thing is a sales ledger control account, it's a ledger account, sales ledger coming from the debtors. So the automatic balance brought down will be here. All right, so that is that. So it is a sales ledger control account, which means debtors ledger control account, and therefore data is part of an asset. So so therefore each time it is increasing, you have to what? Debit it. Each time an asset is increasing, what do? We debit it. All right. Now, however, in a control account, you can also be given a balance for the credit side. Take note of that. You can be given a balance for the credit side. So, and what will happen that a customer has this kind of balance? What do you think will happen? What do you think? Basically, three things can cause this. Basically, three things can cause this. This one can be caused by three things. So let's discuss that. How can your customer, so this one means that this balance brought down on the debit side means that your debtors have increased, which means that your receivables, you need to collect money from somebody. That's why it is debited. Now, if you have it at the credit side, if there is a balance at the credit side, what does it mean? It means that you are rather owing your customer. So if you have this balance, if something that is supposed to have a debit balance is now having a credit balance, then it simply means that you, the company, you rather owe the customer. And why would this thing happen? that you are in such a way that you are owing the customer? There are three possible reasons, and I know you have an idea of some of them. You can only owe a customer one if he overpaid. Is that not it? If a customer overpaid, then it means that you are now owing the customer. So basically, that is one of them. Number two is that probably you gave the customer a discount, but the customer paid the full amount. So that is that. So where you issue credit notes or discount, which is supposed to reduce the amount the customer is paying you, but the customer not knowing it, pay the full amount. So where there is credit note or discount, yet customer pays full amount of invoice. So it means that in that case, you owe the customer that credit note or you owe the customer that discount. So basically, that is that. The third reason is that a customer can pay in advance. Payment in advance. So if a customer pays in advance, so far as you have not delivered your part of the merchandise, it means you are owing the customer. All right, so basically that is that. These are the reasons why you have balance brought down at the credit side of a sales ledger. So basically that is that. Now, the remaining things, you ask yourself, is it going to increase the customer's balance or it is going to reduce the customer's balance? So now, let's say there is a credit sale. So if there are credit sales, what will happen? Is it going to increase the customer's balance or is it going to reduce the customer's balance? The fact that the customer has bought from us on credit or we have sold to the customer on credit means that the customer's debt is going to increase, and data is an asset. And if it is increasing, what do? You have to debit it. So here you will see that you have issues like credit sale. You have credit sales. You have to increase it here. What will cause this credit sales to reduce? Don't forget, return inwards. So sales return or return inwards. Okay, so if he also returns some of the things, then it means that it has to now reduce. What will also cause the customer balance to reduce again? When they make payment. So now, so bank receipts. So when the customer now makes payment into your bank, then it means that it is reducing the sales, the credit sales that he did. It is reducing the balance of the customer. So that is that. So basically, this is it. However, you saw that there is this balance here, which means that the customer overpaid. Now, therefore, what if then there is a refund? So if you see a refund to a customer, what then will it be? Then it means that we are paying this money out. So you have to refund it. So if you see refund to customers, you have to debit. And you are debiting it because you are reversing these kind of things. That is the meaning. All right. So when you have the refund, and that refund probably you pay into the customer bank account. So that is basically that is what you are going to do. So that is that. So if you refund to the customer, that is that. Now you saw that the customer might probably pay you here. And so you took the check to the bank. And let's say when you took the check to the bank, or he paid you by check and you took the check to the bank, when you go to the bank, the check was dishonored. The bank didn't honor the check. That means that you have to reverse this thing that you did because the customer's payment did not go through. So let's say he paid you with several checks, one of them didn't go through. The one that did not go through, you have to reverse it from this one also, and therefore that one we call it what? Dishonored check. Dishonored check. And you have to do this with the understanding as I'm showing you. It's not about memorizing that, oh, credit sales at the debit side. You have to understand it. Why you are doing that? Why is this dishonored check like that? Why is the refund to customer like that? So you really have to understand that. Is that okay? Now, let me ask you another question. Your customer is owing you. He has not paid. So you decide to charge interest on the debt of that customer. Which side will it go, debit or credit? So you ask yourself, is it going to increase the customer's balance? Yes, it is going to increase the customer's balance because you are charging interest on that customer's debt and it is going to increase the customer's balance. And so therefore, as the debtors is increasing, what do? You debit. So again, interest on overdue debt, on customers' overdue debt. So if that customer has an overdue debt, then that one too, the same thing. Again, if some customers are owing you, all right, and you feel like this guy, you will never collect the money. The guy is bankrupt. You will never collect the money. It's not possible for you to collect the money. Probably he died or something. Maybe it's not possible to collect the money. What does that do to your debtors balance? It means that you will never collect that money and you need to take it out of the debtors balance. And so therefore, if there is any irrecoverable debt, what is the other name? Irrecoverable debt. And another name for irrecoverable debt, for popular one that you know, is the bad debt. Then you have to take it out. So that is that. What if you gave the customer a discount? So you also gave him a discount to reduce his balance. So you have discount allowed. You gave the discount. Then it is also going to be also recorded like this. So take note of that. Now, sometimes when customers are owing you, they may give you a bill, or let's say they will give you a draft, a banker's draft. Okay. So that one is a guaranteed document for you to collect your money. Sometimes it may be in the form of a bill, it may be in the form of what do you call it? A banker's draft. So you have it, you can take it to the bank anytime, a guaranteed document or check. And sometimes we don't want to use the check most of the time, but we call it a bill or a draft. So if you take it to the bank, then you can collect your money at any point in time. So therefore, if you have what we call it bill receivable, it means you can go to the bank and collect the money. It is guaranteed, all right? Nothing will happen to it. It's guaranteed. So if you have a bill receivable, then you can. So let me just put it here. You see, in my days of going to secondary school, all right, we used to use banker's draft to make payment for school fees because it was so guaranteed. All right. So that is that. So anytime the school takes it to the bank, they can cash out their money. It is as good as you are being paid because it is guaranteed. However, if some reason the draft or the receivable is dishonored, then it means that we need to reverse it. So bills receivables dishonored, it means we need to also reverse it because that thing didn't go through. So basically, these are the things. Again, that bad debt that we have recorded here is money that we think we will never receive. However, if we receive that money, if that bad debt now later is received, then it means that we need to also reverse this one so that the debt can be standing. So we say that bad debt recovered is also recorded here. Now watch this. You will say, oh, but the bad debt recovered is money that you are receiving. Why are we not reducing it by crediting it? No, because we reduced it here, but we have now collected the money. So what we are reversing is just only these two parts. We are just reversing this one. That's all. That's all. Then the last thing that we probably want to talk about in terms of the item is what we call contra entry or set-off entries. Set-offs. So we have what we call set-offs or contra entry. So set-off. And I'm going to explain to you contra settlement. Now, what does that mean? Assuming your customer, the person that you sell to, is also at the same time your supplier. you also buy on credit. So you sell to him on credit, you also buy from him on credit. In that case, it means he will be owing you at a time. You too, you will be owing him at a time. So you can say, oh, let's set off the trade. Let's say the customer is owing you 1,000 and you are also owing the customer 800. How much can you set off? Can only set off 800. Is that not it? So that 200 will still be maintained in the books. All right. So if there is such a situation, that's what we call it contra settlement, set off. All right. When the customer is at the same time a supplier and you happen to owe each other, then it means you can set it off. Now, when you are setting off, you are setting it off. It means you are reducing your payment, your liability payment, or your what do we call it? If the customer, you are setting off in the customer's books, means you need to reduce the customer balance, and that is why we are crediting it. When it comes to you paying the person, it means that you are also going to debit because you are reducing your liability in your purchases ledger. So this is what you have. All right, that is it. Now, like every account, we need to close down the account. You need to close down the account. But what you are supposed to know under an account, all right, or any ledger, is this. So this is it. Now, in this is an account. If I say that this account has a debit balance, then it means that once I finish preparing everything at the end of the year, the balance brought down should be at the debit. It should be at the debit. That is the meaning. So go back and watch the video on how balancing off an account. Now you see that you have to, if you have figures here, let's say, so let's do a quick recap on balancing of an account. Balancing of an account. So let's say this is an account. All right. And let's say I have 1,000, 2,000, 5,000, 6,000. Here is 5,000. And I'm supposed to balance this account. It means that the total here must be equal to the total here. That is what we mean by balancing of our account. The balance at the debit side should be equal to the balance at the credit side. Now, first procedure you do is that you first use your calculator to punch to find out the place which has the higher figure. So if you do this, you realize that this one is 12,000. Is that not it? Because this is 6 and this is 12. But you realize that this is just 7,000. And so this place is short. So you need to top up that place by doing balance carry down. All right. So this is 7,000. Therefore, we need extra what? 5,000. Now, this balance carry down in the next period will be the balance brought down here. So you come and write. So a balance carried down in one period is equal to the balance brought down in the beginning of another period. So that is that. So this account, because the balance brought down is at the left-hand side of the account, we will say this account has a debit balance. Why? Because the closing balance, not just the beginning balance, the closing balance. All right. So you see, this closing balance was at the credit side. And because we will have to begin it at the opposite side, we will call this one what? A debit balance. So we say an account has a debit balance when the balance brought down is at the debit. And the same thing happens to the credit side. We will say an account has a credit balance when the balance brought down will be at the credit. So imagine if the balance brought down will be here, then where would the balance carry down be? Exactly, somewhere here. Have you seen that? So that is how it works. So in doing your control account, when you finish this, most of the time, the examiner will tell you that even in the sales account, there is a credit balance. What does it mean? It means that as I'm about to total these things together, okay, as I'm about to total it, so let me remove this thing we did out. So as I'm about to total it, when I finish totaling it and we are saying that it is having a credit balance, then it means that a balance brought down should be here. And the question will give you that figure, the balance brought down, since it is saying that it's a credit balance. And guess what? Because it is they gave you a credit balance and you are recording it here, then possibly there should be a what? A balance carried down over here in order to do this. Now, that is that. But what are we doing? We are doing a sales ledger control account, debtors account, which means that you should know that as a debtor is an asset and assets have debit balances. This balance, we should have a proper debit balance. So we will total everything, including this one they've given us. We will total it. We will total it because it is a sales ledger control account, which should normally have a debit balance. We will do the total, and you realize that when you do the total, this side is becoming way bigger than this one, and therefore you will have another balance carried down here. All right, which of course will be the balance brought down also over here. All right, so that is it. So this is how our sales ledger control accounts look like. So in the exam, what you'll be given will be some figures. You should know where each one of them should go to. All right, so that is that. I don't think it's difficult. Is that? Because you need to understand. Once you understand what you have done, then everything is easy peasy. You are gone. All right, so that is that. Now let's look at the opposite side, which is the purchases ledger control account. What are some of the things we think will be in the purchases ledger control account? So let's start. Of course, this is a purchases ledger, and it is a ledger that contains the account of creditors, the summation of the creditors. So obviously, we should be having a balance brought down where? Here. So that is that. This way. However, in the question, you may be given an opening balance of the purchases ledger control account that is a debit. Is possible. And what does that mean? It means that this time, right, it's not your customer that you, the entity, you are owing. It means that your supplier is rather what? Owing you. In this case, it means you rather did the overpayment. Have you seen that? Which means that your supplier, instead of you owing your supplier is now owing you. So that is that. So here too, you may see something like a refund. And what is being refunded? What is actually being refunded is this figure. So sometimes the question will give you the refund amount. But if the question doesn't give you the refund amount, then it means that the balance that was there, which shows that now your supplier is owing you, is what is being refunded. So it can be a trick in the question. So the question can trick you and say that the supplier refunded the opening debit balance that you see here. It's possible. So that is that, but without giving you the figure, but you should know that that is the figure. All right, so the refund. So what is the refund doing? It is just canceling out. All right, so basically that is that. However, anything that will cause your debt to go up in terms of you and your supplier, so anything that will cause you to have to pay the supplier a more amount will be on your credit side, because a creditor is what? A liability. And when liabilities are increasing, what do? You credit. All right. So if there is a credit sale, credit purchases, then that one too will be here. So that is that. That is that. Now, if you have a balance or a credit amount or a liability to pay to your creditor, and you have not paid, and he is charging you an interest on that money, what does that do to you? It is increasing your debt that you have to pay to the supplier, and therefore interest. So the interest on overdue balance. So you have to be very, very careful whose balance the overdue is charged on. Is it a customer or a supplier? So who is doing that? So that is that. All right. So just of course, in this one, when there is a return outward, so if there is a return outward, it will rather come here. So if you pay payment, instead of receiving, if you pay, it will also reduce that. All right. So that is that. There's nothing like bad debt in a supplier account because you are not the one keeping the suppliers' books for them. You are preparing how much you owe, and you cannot sit in your comfort of your home and say that you are recording a bad debt for money that you owe somebody. No, it's not possible. It's not possible. It is that person who has the decision to record, but we are not recording it in their books. We are recording it in our books. We are group H. So that is what we are doing. All right. So there's nothing like bad debt inside the purchases ledger control account. So take note of that. However, there can be discounts received. Discounts received to reduce the money that we have to pay. In the same way, which one? What do you think this one will be? This one will rather be what? Bills payable. So that is that. If you have bills payable, and what is that? So you see, we have explained this one to you. It is not like you owe the bill, but it means that you have given the supplier a bill, like a draft. Okay, so a draft, and which is a guaranteed payment. Okay, so that is that. That is basically kind of what you have given. That is why it is reducing your debt. But if that draft becomes dishonored, if they take it, so and normally we shouldn't be having these things inside the control account like that. But because, for example, if you said you have used a draft to pay, all right, you did that to reduce. But if the person now tells you that, hey, Mr. Group H, when I took your bill to the bank, they dishonored it, then it means that we have to cancel this one out. All right. So when I took your draft to that place, it was dishonored, then it means that we have to cancel the draft. We thought we have paid. All right. So, ladies and gentlemen, that is that. The last thing that is left here is this set off. Okay. Is this set off? The set off. So what did we do? Did we do with the set off in the sales ledger? You see, we credited it. So here we are reducing our balance with the set off or the contra. All right. So that is that. Now, if the question now gives you a debit balance in the purchases ledger control account, a closing debit balance in the purchases ledger control account, what then should we do? Obviously, then what we need to do here, when we total this side and total this side, since they said it's a debit balance in the purchases ledger, then it means the balance brought down should be where? At the debit side. So that is that. Balance brought down is here. And the fact that the balance brought down is here means the balance carried down should be at the opposite end, which is what? Here. But this is a purchases ledger control account. So that is that. It should rather have a credit balance. So when we total these things, you realize that you will have your own credit balance as it's supposed to be. So the credit balance brought down will be here. And if the balance brought down is here, then it means that there is a balance carried down over here. Ladies and gentlemen. So basically this is it. All right. Now that you have understood this, let's go to the part 2 of this video and deal with as many as questions that we have in our tutorial set. So see you in the part 2. Grab the understanding from here and see you in the part 2 video. Bye-bye.